And when these model capabilities are available, which they will be very, very soon, that's it. Like, it's game over for these companies unless they stay right on the cutting edge.
Yeah, and we hope that's not too much of a bummer, but with narrative investing of the last episode, I think this is a pretty good warning to those that can buy too heavily into the story without any numbers backing it up.
There's like CrowdStrike, Palo Alto, the giants in this cybersecurity sector. And then there's kind of everybody else. And there are hundreds of other competing companies. But for my money, these are the two like gorillas.
I also think the market is only capable of looking forward about a year, maybe sometimes two, where once the numbers and once whatever the manufacturing process is seen, the market does extrapolate forward, right?
For an advertising-free version of this show, check out wallstreetwildlife.com.
Welcome to the Deep Investing Jungle with your hosts Luke the Badger Hallard and Christoph the Monkey Pajkowski. On this week's show, we've got an interesting suggestion or a question about quantum computing from one of our Patreons that we're going to wrangle with. Plus, you lucky listeners, 3 King of the Jungle stocks this week. Christoph is going to be giving us an update on Oddity, and I'll be digging into CrowdStrike and Palo Alto networks.
Badge, what's this new toy you've been teasing me with? I've been waiting all morning. You said you got the goods. You got some sort of investing adjacent goods.
I got a gadget. So, if you check out the video on the YouTubes, I got me a robot mower for the back garden. And here he is, at high speed, charging up and down, mowing the grass to a precise 70 mil. Now, the reason it's investing adjacent, this is quite interesting. So this fella was £1,100, which is about, $1,500. It's got LiDAR. It's got a whole ton of sensors, but it has LiDAR. That is how cheap LiDAR is now. And the robo-mower is pretty smart. Like, he mapped out the garden. I've got like on my app a picture of the garden, and and like he can see where he's going, and he avoids like the cat, although he hasn't encountered the cat yet. Like I've got what, like a 50-60 grand Tesla on the driveway that don't have LiDAR. LiDAR is cheap. That's the main reason I wanted to share that little anecdote and video today.
So my main takeaway is that the Brits love their grass even more than I initially suspected. And I've been to the Cotswolds, my friend, and I've watched Wimbledon, and I think grass might be the thing that the Brits take the most pride in of anything in your fine country. Would you say, actually, if I could pose this to you as a question, what is more precious in your life? Your lawn being, I think, precisely manicured, as you started saying with your newfound gadget, or Greg's sausages?
The lawn, clearly. I'm not a fan of Greg's sausages. I like Greg's the company. I don't like the product. I would like a healthier lawn. Honestly, my lawn is shit. It's a complete mess. I've had some fellow Richard coming for the last 2 years every quarter to like treat it and do stuff with it. And I think the robo mower is like the thing to get it over the edge, because it mulches, like it drops little bits of like a millimeter of grass every day onto the lawn. And every time that'll like self-fertilize, and hopefully the lawn quality will get better. But it's not a very nice lawn right now.
No, this is great. This is great. I like where this is going, because I could picture you in your backyard, in your hammock with a pina colada while your robo friend does your lawn. Whereas Monkey here got himself a manual, old-fashioned, like no gas, no electricity. You got to push that thing, get these guns all sweaty and glistening. That's the difference between me and eating. Good for you. You know what we should do for a holiday gift? Is we should make a calendar of our lawns and our unique mowings.
Cool. Lawns and your guns.
Oh my goodness. Okay, so there you have it, kids. Badger is no longer mowing his lawn by himself. we got a wonderful question from one of our Patreons, Andreas, which I'd like to read, Badge, out loud, verbatim. It's worth spelling out. So Andreas writes, my second suggestion to your podcast is a more open-minded talk about quantum computing. After listening to the podcast, I understand that both Badge and Monkey are tech enthusiasts and generally tech future optimists who are willing to hold stocks for several years until the thesis plays out. This has led you to have great faith in the accelerating development in both AI, such as Nvidia, Iron, EOS, etc., and the space industry, such as ASTS, Rocket Lab, SpaceX, etc. Still, you have seemed quite skeptical of quantum computing. I understand that there is a lot of hype and dubious companies that want to benefit from this hype, but I still think that companies like IO and Q and IBM are serious players that could have an exciting future over a longer horizon. As I see it, the economic potential of AI in the space industry is already becoming more apparent, while quantum computing is still much earlier and much less understood. But that is also why I think it is exciting from a risk-reward point of view and may be worth a small allocation. If the technology keeps improving and more practical use cases appear over time, I think serious quantum computing companies could become interesting investment opportunities before the potential is obvious to everyone. Signed, Andreas. So, Badge, let me start my response by saying this question comes to us on the back of the episode we just recorded with Daniel Rubin about narrative investing. And we ran out of time on that one to address this. I'm of two minds here. I do enjoy a good narrative. It's important. And I think with something like quantum computing being the next big thing in computing, that could in fact give it a lot of chutzpah, a lot of fireworks. Two, I'd like to say that nonetheless, I refuse in this moment to get all uppity over quantum computing, and it's for a very specific reason. And I'm curious if you'll agree. I, in my investing framework, have a bucket that I call hope. And I have another bucket that I, hopefully with more discernment, call forward-looking, a market that's forward-looking. But I also think the market is only capable of looking forward about a year, maybe sometimes two, where once the numbers and once whatever the manufacturing process is seen, the market does extrapolate forward, right? Here's what we know now. Here's where it will be in a year. We're going to price it as though it's a year ahead. Sometimes it's a little more than that, right? Therefore, I've invested in this way, right? ASTS ain't making no money, but it is sending up the satellite so we could project a year out, right? EOS batteries, they're not really making much revenue now, but the manufacturing is coming on board. We could project a year or two out. Still not in hand, but on its way, so to speak. As far as I understand, and I think you are the more sophisticated quantum computing thinker of us two, from everything I've learned, this is at minimum 4 years out commercially. So it's like a science project for the most part, in there may or probably will be applications. But if it's so far out, then at this point, all you are buying is a narrative. And during any downturn, when there's no there, and won't be any there, I can't see it being a skillful use of capital other than like a game of musical chairs and you're riding some sort of momentum.
I think you've sort of accurately captured the essence of my view. Like I was going to come to this conversation, and like I appreciate Andreas's message, and you and I have debated it back and forth quite a lot. And so apologies, Andreas, it's taken us ages to actually come together and talk about it. And he made another suggestion, which is very good, which we are going to explore. I was going to come to this like with a joke and just like, oh yeah, we should also investigate like my mate Dave's perpetual motion machine. And I've got this great idea about cold fusion. And like, this stuff is BS. Okay, like if I were to park all of that skepticism and I've been basically piss taking, maybe there is some utility in quantum computing as a field. And it's still, like, as you say, agree, it's a science project right now. Two major problems I have with IonQ in particular, but the whole field in general, right? Like, thinking about the conversation last week, narrative and numbers. The numbers make absolutely no sense, and the two things do have to go hand in hand. I personally do not buy the narrative. The number's ridiculous. It's like a $22 billion company today. And the reason those numbers is like I'm referring to last week's conversation, like Raining Man banging my head going, well, the numbers, like this thing's impossible. There is no business model for these companies right now. There is a business model for something like ASTS, which is essentially pre-revenue, but if they can solve, like there are still some major engineering hurdles to cross, like a fraction of the complexity of quantum computing. But if ASTS can kind of cross those hurdles, which isn't a given, like in my mind, you and I have been debating on WhatsApp just today. In my mind, ASTS is still a really high risk investment. But if they don't solve that thing of putting like cell towers in space, someone will. Like because there is a real business model there, and there's a real like consumer demand, and there's a whole bunch of other stuff you could do around like sensors and like monitoring and Internet of Things. There's like a whole ton of applications that capability opens up. If somebody solves quantum computing and can have like a stable, like enough qubits to be able to solve real problems, it's still unclear what the actual business model is. Like I'm sure that would be useful in a whole bunch of fields of science and help us progress things. But it's quite limited what you can actually do with a quantum computer. There's like a very small number of algorithms and problems that actually provides an advantage where there is a true quantum advantage and you can get value out of what, that we will find as humanity, we will find a use for this stuff. But is there enough of a use to justify like a deca-billion-dollar company? I don't think so. And the other problem I have with IonQ is it probably isn't going to be them who solves it. It's probably going to be like Andreas mentions IBM. Probably is going to be like an IBM or a Google or someone like that has enormously deep pockets, because there is so many sort of scientific challenges to solve as we try and figure this thing out, let alone work out what I'm going to do with it. How far can IonQ keep diluting its shareholders to raise money to invest in the science project? I ain't got a clue, but they're not going to see any of my capital, that's for sure.
Exactly. And on that point, Badge, let's assume actually there ends up being a business model. And let's even give any one particular small shop the benefit of the doubt, for argument's sake. Because we're talking about a paradigm shift that would basically affect the entire world, aka the invention of the internet, and or now we have the uprising or evolution of AI. Do we think that the stock of a company is just going to pop one day and then all of a sudden, right, that's the end of the growth? Of course not. Like if quantum becomes a thing, you're going to see not just days, obviously weeks and months, but years of valuation following this new paradigm. So sure, you miss the first day, you miss the first week, you miss the first 3 months, right? You ain't missed nothing yet. kind of like Nvidia, right? Like you once Nvidia proved its turnaround, you had a lot of time after the stock already started going up. And so this is I think there is no need to be so early, because the downside, as you already pointed out, is severe. You're going to be diluted in terms of both capital and equity, and you'll be what's it called, playing the cost opportunity game.
Yeah, well said. Like this, if like in the kindest way, if we think about this on like the Gartner hype cycle, like we are definitely on the far left on like, climbing up the hype curve with quantum computing. And there will definitely be like a reckoning at some point. I'm actually skeptical about the long tail, where maybe it literally just goes nowhere. But maybe in, you said 4 years, I think possibly closer to 40 years, maybe 14 years, maybe we do figure out something we might want to do with this stuff. And maybe there is like a sort of valley of despair and then a climb up into, efficiency and productivity and doing real stuff. But right now, this is just on the most uninvestable segment of any segment is on my radar. So, yeah.
Yeah, and we hope that's not too much of a bummer, but paired with the narrative investment, with narrative investing of the last episode, I think this is a pretty good warning to those that can buy too heavily into the story without any numbers backing it up. Maybe that's the most succinctly you could say. And here's the other thing. We could be wrong about this, of course. There is such a thing as tulip mania. And so, sure, the stocks could, tulips were, that's a far outlier of things people have lost their minds over economically. And so this is much more important and substantial as an idea and as a science project. But, so sure, the stock price might go up from here, but, people win at the casino. There's hot streaks. And so as far as an investing process, I don't think that's what we're looking for ourselves.
All right. Andreas, hopefully, it probably wasn't what you wanted to hear from us, but, just both sharing our views. I think Christoph's right. Like, you even if you even if you're not an investor in this stuff, if suddenly there is a business model and suddenly there is like a pathway to realizing business model, you're still going to have, like, it's going to be flagged well ahead of time. So you're going to have an opportunity to invest when, like, some of the ludicrous risk has come out of this stuff, and it's simply extreme risk as opposed to being like unbelievably extreme risk.
The only analogy I could argue against that is in biotech, where you have the pre-FDA approved company and then you have a post. So you if you invest before, you get the benefit of the post. If you invest after it, you've missed much of the gains. But that's also not true, because that company could then grow. But that's a very different paradigm than I think what we're talking about here with quantum.
And, even there, like, to not so sort of hand of the analogy, but, with biotech, these companies don't investigate random drugs just for fun. They spend billions of dollars because they know if this drug works and if they pass like clinical trials, there's a business model, that there's a market, there's a need, there's, enough patients with this condition that they can resolve and they can sell it for, so many tens of thousands of dollars per injection, whatever the hell the thing is. But with quantum computing, you don't even have a business model. You've got nothing.
All right, Badge. I'm ready. Okay. I'm ready to tell you about, I'm ready to give you an update about a newish King of the Jungle stock in my portfolio that had all kinds of trials and tribulations lately. You ready?
I'm ready, and I apologize like you're going to get. I'm in like angry skeptical mode, having come up with that quantum computing. So, and I know the company you're about to tell us about, so I will try and like bury the angry back.
Oh, don't bury. No, there's nothing you like better than a good stick of lipstick. So I have a strange company. I want to tell you about, or rather, should I say, an odd company called Oddity. What they do, Oddity Badge sell beauty and wellness products straight to people online, direct to consumers, the model. So they basically cut out all of the going to retail and sacrificing margins. And they have 3 brands. Il Maquillage for making your face prettier with eyeshadows and lipsticks. Spoiled Child for hair, skin, and supplements. This is what Monkey bought himself, some orange mango flavored skin improvement. You see how shiny I am. And Methodique, which is a telehealth platform for more serious dermatological issues, acne, eczema, hyperpigmentation. So it's legit telehealth. And they have a biolab in Boston, and they have a lot of data, about 70 million users that go into basically custom making these products for people. All right, so here's the thing. The trick to this company is never the beauty company piece. It's that it's a tech company that is using sophisticated data sets and AI and lab molecule making. They're putting it together and saying, okay, we know more about our customers than any beauty/health company has a right to. And this is our moat. And we're just going to sell this to them directly. So in 2025, they were growing 25%. They did a record of $810 million in revenue at very high margins, approximately 70%. And that's where I got interested because the stock actually went down quite a bit. And I was looking at this and like the valuation has gotten really, really, really cheap all of a sudden in light of this kind of performance. And then a bad thing happened, Badge. Last quarter, 2 quarters ago, the company reported that all of a sudden their cost for customer acquisition skyrocketed. And their margins basically went belly up. And all of a sudden, the growth stopped. In fact, it dropped. Stock fell 49% in a day. Earnings came in down 26%. And then bad thing, right? Basically bad. So what we know is that, or can very seriously infer, is that Meta is their ad partner. There's algorithms, and all of a sudden the algorithms did not like something about the way Oddity was marketing. It was most likely the try before you buy program, where Oddity generally in a pro-consumer fashion said, we want you to actually try the products, and then if you don't like them, send them back. But that kind of led to enough lower quality consumers. So all of a sudden prices went up and Oddity was left with like, what the hell? Here's the thing. In the latest earnings, they reported 26% drop in revenue rather than their predicted 30. So it was actually a little better than expected. And we got a little piece of news. They actually said, Badge, that over the last few months, the cost of customer acquisitions went from bad in January to worse in February to worse in March to even worse in April. So it actually started spiraling out of control. And then finally in May, when they, the earnings call was, I think, early June, they said they finally reversed the trend and were directly working with the engineers who said on the call, they most likely have a solution that could probably bring the cost of acquisition back down 40 to 60%. So while all this is going on, right, we have a balance sheet, which if you take away the debt, they have like 600 million in debt, or used to have 600 million in debt, financed at 0%, over 750 or so million in cash. So you net, they're still net cash positive with a big credential revolver in case they were ever to need that. And they're all of a sudden buying back shares very aggressively. While this is all happening, so that's one, And two, just recently they financed, it wasn't talked about much, but they refinanced. They actually bought back 50 million of the debt for only 35 million. So they, out of nowhere, made $15 million. And so this is a company really that in this moment has what seems to me, Badge, a very fixable problem that has already been acknowledged on its way to being fixed. What is the bear case here? The bear case to me is very obvious. They are facing an existential crisis, being dependent on Meta for their survival. I mean, as far as I could tell, there's no second best. And this being their model, the direct consumer, most of their customers, most of their ways of doing things depend entirely, apparently, on Meta engineers that for about 4 months could not figure out how to make this problem go away. How does that make me feel as an investor? Not very good, honestly. But it's the fact that they said, look, we spend so much money here. We're in direct contact with these guys. These guys are already turning the knobs the other way. And the insiders are, basically investing back into the company, knowing what they know. To me, this is one of those moments that I salivate over as an investor, which is risky, because if it wasn't risky, we wouldn't get the valuations. But enough evidence that the ship is already turning that I want to be in before next quarter or 2 quarters from now, where they say, yep, we figured it out. It was the try before you buy program. We're getting rid of that, which actually they said anyway, because that might have been a thing that already expired its welcome. But now, it's not like a company on the verge of bankruptcy with lots of debt and no way to service it that's out of options. So I'm sniffing real value territory. And the moment, Badge, last thing to answer the question, should you invest in this company? Think about what you'd be buying. 3 brands, a 4th one on the way, data flywheel, strong cash position, and a problem that has nothing to do with the brand, nothing to do with consumers themselves, nothing to do with like something being off or wrong with any of these forward-facing things. It's a pure technical, mechanical problem, as they said on the call, that is on its way to get fixed. You fix that, back to growth, and I mean, this is beyond value territory. So my position right now, should you buy Oddity, is if you are very risk averse, this is still too risky because they might not fix it, or who knows what will happen. Other than being really risk averse, this is a company with a really savory risk reward ratio, as I like to think of it. And you may wish to take a small dip at these prices and wait until the next quarter, see how much of the problem they've managed to resolve, and then add if they do say they have in fact resolved it. So I'll pause there, and I know I have a chart from Fiscal AI that I want to show, but maybe you could give me some of your feedback first.
Yeah, I wasn't a fan of the business itself. And mostly just me, I don't understand investing in those sort of consumer type brands. I recommended Nike years ago to start investing, but if I'm honest, that's not my wheelhouse. And as Lululemon shareholder and Under Armour shareholders found out to the chagrin, right? The market sentiment can change quickly, brand can fall out of favor, and it's just literally game over. That's it, right? And I'm not sort of close enough to the zeitgeist of what millennials and Gen Zers and stuff want in terms of debt makeup and stuff like that. So I would never see, I would be like the guy caught out. I wouldn't see the problems coming. So I would never invest in this kind of stuff myself. But you've got a massive margin of safety, as you say, in the numbers right now, because it's trading for what, that's the one-time sales. Seems, as you say, seems to be well capitalized. So they don't need to do much to turn that around into those numbers, the gross multiple to come back out.
Yeah. So Badge, actually, what you could see here on this pretty chart is that the revenue growth was really strong for many quarters in a row. 30, 55, 37, 44, 28, 27, 26, 27, right? And then all of a sudden it drops to negative 26, the tech issue, right? But that's a lot of quarters in a row of strong growth. But then look at the margin line, 70% margins, right? Now, to your point, I also am not usually a fan of product consumer brands, if you will. But I am really interested in this one because I do generally think once they got past the makeup company, Il Maquillage, right, which is all done by the influencers, people, millions of account, right, young women showing how to apply this, that shade or other, right, whatever. But then you have that health wellness side of it, the one I sampled by ordering my collagen, which tasted good. I mean, I don't know, maybe it's, what's it called, placebo effect, whatever. I like drinking it, it made me feel good. But the wellness stuff, selling vitamins to people, that's always going to be a thing, right? Always seeking the potion of youth. But then when they entered the more sophisticated telehealth thing, which is like HIMSS territory, you know, like if you generally said to a teenager, we're going to help you with your acne, we're really going to make you look better so you're not embarrassed going to a social function, right? And they're collecting data with 3 of these, right? And the AI is now obviously getting more powerful, spreading the data pieces amongst the 3 tentacles. Then you add a 4th brand. And what you have here generally seems to me more like a new age tech platform that happens to sell these particular products, but that's very different than a Lululemon or Nike, which is all about the logo. And I could get really excited about that kind of thing. But then when you show me the numbers, right, and you get this special situation that seems to be, hopefully, fingers crossed, a one-off, I mean, this really is a kind of, at the moment, monkey stock du jour. This is exactly the setup I long for, and it's not guaranteed, but it's exciting to me.
I lost my pants on like being during the pandemic, thinking about like telehealth. I just got way over my skis with that one and cost me dearly. I can see how dermatology as a discipline does make sense as a telehealth kind of thing. You know, if I want to get my blood pressure checked, no, like cameras ain't going to help me. Like a doctor can't listen to my, pleurisy infected lungs over Zoom. You got to go and see like a real doctor face to face and get most stuff for what. But dermatology is, like it is on the surface, right? So I can see how that makes sense. So I see it's a monkey stock. It's definitely not a badger stock, but like the numbers look good. I do support the numbers, even if I don't buy the narrative.
Yeah, and by look good, you mean they're down to 650 million market cap, right? They're sitting with that much cash on the balance sheet. So
yeah,
forget the debt. If you bracket out the debt, which, I mean, regardless, right? That debt is not due till 2030. So literally, they have as much on the balance sheet as they are worth. And the market in this moment is basically translating to, we do not believe that you will solve this customer acquisition cost problem. That's what the market is saying. And when Monkey tuned in to the last call and he heard them saying, we are fixing this problem because it's mechanical in nature, then I'm seeing like that divergence that I want to see. And,
I'll jump in on this because I don't know anything about the specifics. I have just run a pretty complicated ad campaign on Google AdWords for a friend's business, just trying to help him kind of get off the ground. And I really went down the rabbit hole in understanding it. So I don't know much about Meta, but we did a couple of Facebook adverts that were pretty like low tech in terms of the approach, but I put a lot of thought and structure and put like tracker and all sorts of things to the Google thing. So I feel like I understand a little bit about online advertising now. What is to say that their engineers have like now solved the problem? They've optimized their ad spend to get, because the whole purpose is, you know your customer acquisition cost, and then like the lifetime value of a customer, and you try to spend, your advertising money wisely to maximize the advantage of value of the customer over the cost of acquiring a customer and keeping the customer. What is to say that Meta don't change their algorithms again, and these guys, they've learned a lesson, but then they're back to square one and they've got to go through a whole bunch of more optimization. Like they're still at the mercy of the algorithm.
Nothing really. And I think though, if I read between the tea leaves, these guys are not dumb. I mean, you don't build this kind of business over many years, right? Not knowing what you're doing. I am pretty confident they are looking for or building the adjacent trajectories, if they haven't already, for their products. I mean,
you say they're not dumb, but they got caught out and it wrecked their business.
Yeah.
They've made a lengthen. Yeah.
Right. It'd be hard for me to imagine they are not in the middle of creating the alternate pathways. I mean, maybe I'm ignorant in this. Maybe Meta is the only advertising platform and the only way to reach people, but I doubt that.
There are a bunch of ways, but they're all going to be subject to like different algorithms. Yeah. And part of the game is like figuring out, even for ourselves for the podcast, right? Like we have to constantly keep on top of the kind of stuff, how you should make a short and how you should, like, what kind of, 1 year it's all about like hashtags, little hashtags that are relevant. And then it was about like keywords and then, what category you kind of put your stuff in, constantly changing, and you have to keep adapting. And it's just kind of the name of the game when you're trying to, provide a built day on something online.
Yeah, our problem, Badge, is we don't talk about bananas enough.
Maybe, yeah.
So, but that's easily fixable. You know what the best thing to eat every day for breakfast, lunch, and dinner is? Bananas.
They're a staple in my diet. Banana and peanut butter on toast. That's my go-to breakfast for the last year.
Anyhow, so I'll end my segment by saying that in the King of the Jungle portfolio, Badge, I recently bought a pretty significant slug of Oddity shares on top of the one October call expiring at $15 strike that I still own, on the assumption that this problem gets solved sooner than later. And if it doesn't, I'm probably going to call and buy another call for January.
You know what makes me most happy? I'm looking at the King of the Jungle spreadsheet right now. And by the way, if you're listening and you don't know what we're talking about, like we run a live real-time stock picking contest called the King of the Jungle. It's the badger versus the monkey versus the Patreon community. And there's a real-time spreadsheet. You can see like up to the second pricing. If you just go to our Patreon, you don't even have to like sign up and become a Patreon. There's a link there where you can just see the spreadsheet and you can see our real holdings. Anyway, I'm looking at the spreadsheet right now. What makes me really happy is you told this really like bullish, high conviction story and you have a sensible allocation of 4.4% of your portfolio plus options. So it might add up to like 5%. Great, good. That's, concentrated portfolio, sensible allocation. The monkey of, episode 10, not episode 140, would have been like, I'm all in, like 50%.
No, Badge. You get this wrong again. Oddity, when it solves these problems, after it goes up another 500%, I'll have the same problem as I did with EOS Iron and AST. So, but that's still a few months ahead. You could give me the talking to after that happens.
Should we talk about a really similar pair of companies to Oddity?
Yes, we should.
I suppose there is a sort of Oddity is like protecting your skin, and if you're a company, like if you don't have CrowdStrike or Palo Alto or a select number of their competitors, then you're not protecting the skin of your business. Okay,
that's
the
right.
bad guys are going to get it. Yeah,
that's right. So let
me hit you with it. Right. So I want to talk about these two companies alongside each other because they are like fierce competitors. But it's there's like CrowdStrike, Palo Alto as the giants in this cybersecurity sector. And then there's kind of everybody else. And there are hundreds of other competing companies. But for my money, these are the two like gorillas. I know Microsoft and, there's other massive players there. But in terms of pure play, like focus, cybersecurity, I think these are two good bets. And I'm going to jump ahead and just say like these are high conviction investments for me in my own portfolio right now. But let me tell you what they individually do, and then we'll chat about them as a whole. CrowdStrike. They are the world's leading cloud-native endpoint security company. So they have their platform called Falcon. It's a single lightweight software agent that sits on every laptop, server, and cloud workload in an organization, and it uses AI to detect and stop attacks in real time. And they originally kind of came to market as EDR, which is like endpoint detection and response, where, in the past you might have had these like clunky legacy antivirus type solutions. Every day your software downloads like the latest virus signatures, and then it makes sure you don't have those viruses on your laptop or on your server. So they moved away from the whole thing, reinvented it, deployed a single lightweight agent onto everybody's like endpoints, everyone's like stuff, infrastructure, and all the intelligence sits in the cloud. So the real benefit of that model, that approach is like if one customer somewhere in wherever, Asia, gets attacked and there's like a brand new attack vector, some guys have found like a 0-day, or they're trying to, get into this customer. In the cloud, Falcon Cloud in real time, as that attack is detected and then prevented, the same protection instantaneously is available to every CrowdStrike Falcon customer. So that, that one-time thing is nullified very, very quickly at scale for all of their customers. And that's very powerful network effect, because it means every customer makes the whole thing stronger, because you've got like another, point of attack and point of learning and solving these issues. They've now expanded beyond that. They've got like a whole ton of modules, and most customers, buy increasing numbers of modules. And now they cover like cloud security, identity protection, SIM, which is kind of like log management, data protection, AI security. Like it is a entire security suite. And it's like for my money, it's like the classic SaaS, software as a service type customer. It's all like high levels of recurring revenue, ARR. And they introduced something called Falcon Flex, maybe like a year or a year and a half ago. And Falcon Flex, I used to have to work with like procurement when I went for HSBC. And like I would say, okay, we need this piece of software, and we'd go to a vendor and, we'd buy like $10 million worth of software. But it was a pain in the bum. And you knew that if the vendor suddenly had like some other thing, like a new fancy whizzy thing, you'd have to go and buy that again. It's a whole new like procurement conversation. It's difficult, and it's like, it's complicated for the customer. Well, Falcon Flex kind of does away with all that, because essentially customers buy like credits, which are fungible across all of the modules of CrowdStrike. So, in year one, if you're using, $10 million worth of stuff and you're using like particular modules, well, you could take that same $10 million and you could pivot it across Falcon's like whole ecosystem and buy different stuff. It just makes like the buying process really smooth, really easy. And that sort of supercharges SaaS, because it is like land and expand. Customers are more comfortable buying and increasing their spend if they know like they've partnered with the best in the world, quite frankly. That's who CrowdStrike are. And that they can kind of easily adapt where those dollars are spent month, quarter to quarter, based on like the particular needs they have. Let's take a quick look at some numbers and then we'll kind of open up to a bigger discussion. So got a pretty picture on the screen here. We can essentially see revenue growth against market cap, which has like skyrocketed in the last couple of quarters, and ARR. And like ARR is a number that really kind of draws my eye. It's now been over $5 billion of annual recurring revenue in the last couple of quarters and climbing at like a really great rate. I think ARR, $5.5 billion in the most recent quarter, which was just a few weeks ago, up 24% year over year. Like $5 billion, still growing at 24% year over year. Like these are big boy numbers. Record free cash flow of $469 million with a 34% free cash flow margin. Like this company is like printing money. Let me stop there and give you a chance to respond. Clearly, you know, CrowdStrike.
Curious on this chart, Badge. Q2 of 25 seems to have been the low point of the revenue growth at about 20%. And then since then, it's recovered over 5%, reaccelerated. Any sense of what's happening here? Is this like the moment where enterprises say, "Oh yeah, AI we can't switch off, and AI is actually making things even more dangerous, so we have no choice"?
It's interesting. That's a good observation. Maybe a little bit, but I think AI is like let's talk about AI. Let's come back to AI question. We've covered Palo Alto as well. Like you were talking about the law of large numbers a couple of episodes ago, fairly recently. And like when you're at $5.5 billion of ARR, like the law of large numbers is kicking in. And so you do expect naturally your revenue growth to slow down. And as you've observed on that diagram, like CrowdStrike got to like just under 20% revenue growth. With 20% revenue growth on like $4.6 billion of ARR, it's still decent. It did inflect about a year ago and started climbing again. And we're back up to like 25% ARR growth. Revenue growth, sorry. Part of that was like Falcon Flex, giving customers that fungibility, that flexibility. Like frankly, I know CrowdStrike had that moment in 2024 where they literally like took down the internet because of like a screwed up update. But they navigated that really well. But I think that, you know, that did impact their numbers a little bit. So probably when we're looking at early 2025, we're seeing some of the impact of that because some customers will have gone, oh, you know, screw this, I'm going to go to Palo Alto instead. I don't want these guys taking me out. But I think a lot of customers actually liked the way that George Kurtz, their CEO, navigated that. High transparency, good communication, like owning the problem and solving it. And that probably made customers more confident in the long run that if these guys screw up, like they know how to handle a crisis. So long, you know, it probably took a little while for like the pain of that to work through. And then customers to go, actually, we really like the philosophy of this company, not just the service they provide, like the way they do it, the way they know the handle themselves is good. So I think that will have played into that like inflection, also Falcon Flex, and also like a whole bunch of other capabilities they're adding because I don't have the numbers in front of me, but dollar-based net retention also has inflected and is increasing. So individually, customers are spending more and more year on year.
The other thing, Badge, is it does seem, as per your own comments, that this is one of the most expensive companies, certainly in the software sector, especially now after this real high spike. It's 33 times enterprise times sales. I call that nosebleed valuations. And to an obvious bear point is that's price for perfection, yada, yada. Is perfection something we can, as investors, expect in this age of AI where everything is being disrupted, even things we don't know about? That's, I guess, what would make me worried, even though I do actually counterintuitively buy your case. I do buy your thesis that AI will make companies need more, not less of this stuff. But when you're priced for perfection and you have this Goliath over here that's doing God only knows what, I don't know how well I'd sleep buying at today's valuations, because like, what else do you need to like to make money off of this? You would need you would need further acceleration, or you would need further nosebleed valuation. I don't see how either of those happen.
Yeah, you nailed it. Like, that is the bear case. The valuation is extreme. I still have this as a high conviction investment, even in $174 billion market cap, because of the thing you said there as well. Like, I think AI and like the mythos looming in the world now is going to viscerally demonstrate over the next 12 to 24 months why the world needs like 10 times as much cybersecurity as it does today. And I think companies are probably underestimating like the effectiveness of hackers and the scale of the attacks they're going to be facing once like Chinese open source models can do the same thing that Claude Mythos, and allegedly like GPT 5.5 has similar kind of like hacking capabilities. This stuff is going to be like cheap and easy to do at scale, and companies are going to like get taken out. Like, they're going to get like malwared out of existence, and CIOs, CTOs are going to realize they got to spend way, way more with like the elite cybersecurity vendors like CrowdStrike and Palo Alto and a few others to protect their business, because it is literally like life or death. There's no coming back from, like, if you don't have like good backups and you lose your customer data, you know, not just a reputational risk, you just lose the ability to even do business. But expensive, like, no doubt, extremely expensive. So switch to Palo Alto, because it's kind of it's going to be like the same sort of story, but it is less expensive. And so, you know, there's, in some ways,
yeah, it must be,
story.
It must be less expensive for a reason. I wonder what that is.
So, for the purposes of our YouTube short, let me start nice and clean. Palo Alto Networks. So they're actually the biggest cybersecurity platform company. They started out a long time ago as like a leader in next generation firewalls, which is like physical stuff you put into your data center, into like your racks, and these like virtual appliances that guard your network. But under their CEO, Nikesh Arora, they've executed an aggressive platformization strategy to become like a one-stop security shop and move away from this legacy hardware firewall business to now being, you know, something that's definitely comparable to CrowdStrike in terms of the types of capabilities, and arguably better in some ways, as long as you don't mind the kind of Frankenstein approach that Palo Alto have taken, because they've aggressively, like even in the last year, they've made a couple of massive acquisitions to bolt on important capabilities. So Palo Alto is really built around 3 main platforms. Strata, which is network security, it's kind of like the legacy, the legacy firewall franchise has turned into. Prisma, which is their cloud security, and Cortex, which is AI-driven security operations. And their strategy is basically get like large enterprises to standardize on all of their different platforms. They've like platformized these customers and then just lock in like remaining performance obligation, long-term billings, and, you know, kind of, you know, and they are bigger, higher market CrowdStrike, with some of their recent acquisitions actually potentially superior capabilities. But I'll come on to that in a sec. Let's take a quick look at some numbers before we start like debating it. Similar to the picture we just looked at, CrowdStrike, market cap has like skyrocketed. It's currently a $228 billion company. but also revenue growth has skyrocketed. But that number is deceptive. So I will say, ignore 31% revenue growth. The true number is closer to like the 14, 15%. And I'll tell you why that is in a sec. But ARR, we looked at ARR for CrowdStrike a few minutes ago. That was like $5.5 billion of recurring revenue. Palo Alto Networks, they call it their next gen security annual recurring revenue. That's now over $8 billion. And again, you can see a big jump up. So why did the numbers jump? And there's a little bit of smoke and mirrors in the numbers, which is why you have to understand the story. You can't just go by like the charts and the raw numbers that the company like tries to sell, because a lot of this new revenue was acquired revenue, because they bought two big acquisitions this year. The smaller one is a company called CrowdStrike, which is like a observability platform, a bit like sort of Datadog, if you know what they do, that kind of thing. But they also spent $25 billion, a very big acquisition, on CyberArk, which is one of, or was until they were absorbed by Palo Alto, one of the world's leading identity security companies. I actually owned CyberArk directly like a year and a half ago because I identified the importance of identity security in the world of AI, where increasingly like the majority of the things that log into your system are not humans, they're actually like AI agents, and you've got to be able to manage like what those agents are capable of doing in the same way that you manage humans, but at much bigger scale and much faster, because like agents are operating at like machine speed, not human speed. So so they've kind of, let's compare these two companies. Just going to come up a level and then we can debate these two. You've got like CrowdStrike. It's not that they have done acquisitions in the past, but they have this much more coherent, modular kind of approach. It is still like a single agent through which you kind of access everything. Palo Alto, you've got this more of a kind of Frankenstein. They call it platformization. Maybe there's an element of smoke and mirrors because you have got what is in essence like a whole bunch of disconnected bits of software that they've kind of blanked the Palo Alto like logo on. They these two things. I'm not to use this personally, so I don't have like direct experience, but evidently, this is coming together. Platformization is more than just a green word. It is like becoming coherent, but it's come from a different place, and they're still like a very acquisitive company. So you can probably see, they were growing in a different way to CrowdStrike, but the valuation I think is more reasonable for Palo Alto. I think you picked up when we talked about CrowdStrike. You picked up on the EV to sales of like over 30. Palo Alto is still an expensive company, like 21 times trailing sales, but objectively cheaper than CrowdStrike and doing bigger numbers in terms of ARR.
Badge, again, once in terms of, in light of the narrative conversation we had the other day, when I think CrowdStrike, I see the red eagle, or I see their branding. I mean, I was an owner for many years. The way they show up and everything about their ethos, to me, is that's what Daniel was talking about. When I think of Palo Alto, and I never own them, so I don't know nearly as much, I think of one of those older corporate websites that has a bunch of acronyms and words that nobody understands. And it is this sort of like, labyrinth of jargon, which only IT guys get excited about. I still, if cybersecurity is sort of an all or nothing game, you either do your job or you're dead. I don't understand exactly why, or maybe you could help me understand why CrowdStrike gets such a lofty premium, whereas Palo Alto doesn't. That's beyond the branding.
Yeah, I don't know. Like maybe it's the wrong question to ask, but I support your question. Because the reality is, like, both of these are very, very expensive companies. It just happens that one is even more expensive. So it's not like we're looking at these and going, oh, Palo Alto is cheap. It's just less egregious valuation than CrowdStrike. This is like, we come back to that Daniel conversation. So I found it so useful reading his Reddit post. Go listen to last week's episode if you don't know what we're talking about. These are companies where, like, they're both mature companies. They've got really good, like, good numbers that you can get your teeth into, and you can start to, you can do like reverse DCFs and DCFs, and you can understand the trajectory. And with companies like this, like, you can see remaining performance obligations, which is like, they've got like essentially a contracted revenue out a bunch of years. So you can start to model, and that the numbers tell a really useful story. But if you only went by the numbers, you wouldn't own either of these two companies. You have to hold, in the other hand, the intangibles. And part of that is like, you've got rockstar CEOs in both George Kurtz and Nikesh Arora. They really, like, George grew up in this industry. Nikesh came in from, I think, SoftBank in 2018, but has like a great track record. And he's pivoted the company over the last, 8 years into away from being like the legacy hardware business, so like the modern, mostly cloud-based business. Like, you've got strong leadership, you've got everything else. But to me, like, the biggest narrative thing here is like the tailwind from what's happening in the world and how AI is changing like the game. If you want to protect, even like a company, your own personal brand. I'm almost like autistic right now. Like, every couple of weeks, I'm going around and I'm updating, making sure like my network security is up to date. Have I got like the latest patches for my routers and my access points? Is my phone on like the right version? Because I'm trying to protect my own security. Doesn't make sense for me to buy like a CrowdStrike or a Palo Alto, albeit I could, but it doesn't make sense commercially. But if I want to protect like Luke Hallard Incorporated, I think I'm being pretty smart. I'm not saying try and hack me, you'll probably find a way in, but I'm trying to do everything I can to protect me and my family and my own like data, because I can see what's coming. I can see down the tracks when it's so cheap. It's essentially like the marginal cost of attacking me is almost zero, and that stuff's going to be happening, particularly for like YouTubers. Have you told your mum, like, one day in the next couple of years, she's going to get like a video call from Shishov saying, like, Mama, like, the house is on fire, you need to send me some money. Like, this stuff will happen. Like, bit of hygiene. We've got a family password I've got with my parents. I oversee my parents' pensions, and I reminded my mom the other day, like, I'm WhatsApping her. I'm like, don't forget, like, we're talking about your money, and I need you to send me, like, the 2FA code. Like, you're going to get a code on your phone, send me the number, and I'm going to go into your pension account, and we're going to do these tweaks. And she's about to send it to me. I'm like, do you know it's me? Are you sure it's me? Like, you need to be hyper vigilant. Because maybe it ain't me, and maybe I'm some scammer who's got taken over, like, my WhatsApp account. I'm about to get the code, and I'm going to, like, exfiltrate her pension, and this came over.
Yeah, good point. There was a recent article by deepfake expert saying he himself is already the world's expert on fake AI is already over his skis, being able to discern what's real and what's not. Therefore, the solution badge is my donkey house here in Sicily, in which I have a really sturdy, rusty lock that you will need more than a hammer to break into that vault and safe. And a nice bed of hay. So it's very comfortable, it's safe, it's the place you want to be when hackers come to town.
Don't think about robbing Christoph. I'm pretty sure he doesn't have any, like, gold or wealth. It's all of his stuff is. His wealth is in, like, these intangible companies that have no revenues. That's where his wealth is. Don't be breaking into his barn. There's no valuable. There's the broken car in there. That's about all you're going to find.
The question I always have for you, is I buy the story, I buy the narrative, I buy why cybersecurity will continue being a thing. But today, do you buy these companies?
100%. Yes, absolutely yes. I'm probably going to add to Palo Alto, actually. Like the biggest catalyst to me was Project Glasswing, just to kind of make it really concrete why these two companies in particular now have a massive advantage over their competitors. Because like we've seen now from the actions of the US government, like they've recently like put export controls on Claude Mythos, Anthropic's like latest model, because they're like, this is real, this is a weapon, we have to understand it better before we allow foreign nationals access to it, including foreign Anthropic employees. So Anthropic have really kind of made a difficult bet for themselves the way they've navigated this. But let's just take now as read that these capabilities are legitimately dangerous. Well, Anthropic were doing things, I think, in a smart way with Project Glasswing, where they brought in like a number of the world's bigger companies, including CrowdStrike and Palo Alto Network, excluding all the other pure play cybersecurity vendors. So the Zscaler, bad luck, buddy. And these guys now have an advantage because they have been using Mythos and Fable, and they've not only, I think Nikesh was interviewed by the All In guys recently, and he said something like, I might be misquoting him, he said that they found 500 deficiencies in their own software, not even their customer software, their own software, using Mythos that they've now remediated. And that's a cybersecurity vendor, and they've got like 500 holes. Imagine how many holes their customers have who are not experts in cybersecurity. And when these model capabilities are available, which they will be very, very soon, that's it. Like, it's game over for these companies unless they stay right on the cutting edge. And who is on the cutting edge? These two companies in particular in this sector, because they've been using Mythos for like the last couple of months.
Right. Existential risk. I mean, that's the bottom line. So I buy that thesis. I applaud you for still buying at these levels in terms of enacting the principle of great companies are always expensive. And you hold your nose, and then years later, lo and behold, you were right. I trust that TAM is, the total addressable market is still ever expanding and large enough to keep, it has to be. So given that a lot of the world is still not even on the internet. So yeah, very good, Badge. All right.
Right on.
We both used a lot of fiscal AR charts, as we tend to do. It's where we go to do our stock research, and they have all the data. They have 20 years worth, all the KPIs. You could get really fancy looking for specific company data points that are not available to other companies. You could configure it in all kinds of ways. Now the AI helps transcribe the transcripts, integrate it into insights, tell you what the numbers mean. It's our one-stop shop. Check out fiscal.ai/wildlife with 2 free weeks of Fiscal Pro. No credit card needed and a 15% discount if you upgrade. You can't be a serious investor without it.
Right on, my friend, right on. Are you ready to become a beast of an investor?
That's good.
That's a yes.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.